Welcome to the final installment of the Small Cap Playbook series featuring Seneca Financial Solutions, Luke and Ben, and brought to you by goodresearch.com.au. If you're wanting to know what does it take to become a portfolio manager and what kind of lessons would you learn really quickly if you were thrown in the hot seat, this episode is for you. We're going to talk about a bunch of different companies and use a few examples. But importantly, what we're talking about is Ben's lessons learned. He's got 8 lessons that he has learned investing in small cap companies and through his time with Seneca and in particular Luke Laretive. What has he learned and what can you apply to your own investing? Don't forget, in this series, we end each episode with the Research Desk segment. This is where the team at Good Research actually bring you a kind of stock that you can go away and think about. And if you can identify what it is that they're talking about, they will give you a bottle of wine. Of course, there are only 2 bottles of wine up for grabs with each episode, but if you know the company that they're talking about in this episode, be sure to use the YouTube comments or Spotify or wherever you get your podcasts. Just leave us a comment and we'll try and track you down and give you that bottle of wine. The company that they're talking about in today's episode is probably the easiest one of the lot so far. So if you've played along with the 4-part series, this one is genuinely gettable. So don't forget to leave your comments online. And if you are in the market for an investment subscription, you want to hear more from the guys, head to goodresearch.com.au where you can use the coupon code RASK to get a steep discount on a yearly or twice yearly subscription to the service. All that and more in this episode of the Australian Investors Podcast. Global X is a leader in commodity, thematic, and specialized ETFs. Global X has been a partner of Rask for many years, and I'm so excited to witness their rapid growth over that time. Their range of ETFs, in-depth research, and focus are all designed to help you invest better. Visit globalxetfs.com.au and tell them Rask sent you. I'm hearing a lot of investors asking the same question. Where can I find reliable income in this market without taking equity market risk? That's where Term Plus comes in. It's designed to maintain a steady buffer over the RBA cash rate, providing regular distributions and somewhat of a cushion and diversification on your passive income. To find out more about Term Plus, simply search for Term Plus or head to termplus.com.au where you can find the PDS and TMD. And don't forget to tell them Rask sent you. Welcome to episode 4 of the Small Cap Playbook, joined by the great man, Luke Laretive. How are you, mate?
Rasky, how are you, mate?
And the up-and-comer, Benjamin. How are you, mate?
Pleasure to be here, Rasky.
We are going to talk a bit about Ben today. We've got a bit of a different episode. This is episode 4 out of 4. All this month, in month of June. I mean, there's one in May, but who cares? We've talked at length about catalysts and takeovers in the last episode. At the end of every one of the 4 episodes, there is what we call the research desk. So it's a chance to pick some stocks. And if you get them right, you might get a bottle of wine or maybe a few by the time there's a few left over in Luke's vault. And then in episodes 1 and 2, we talked more about like investment process, about how to find companies, mostly before the rest of the community is looking at them. So go back and check those out. But we're bringing this episode to you today because goodresearch.com.au, which is an investment membership, and it's for people that are proper investors, DIY investors, and you focus on smaller companies, that is on sale and it ends on the 30th of June. So now's your chance to get a membership with the coupon code RASK. It's RASK. Now, with that said, we're talking about Benjamin because, Ben, you've been working with Luke and Seneca for how long?
3.5 years probably now.
Okay, cool. And explain to us why we wanted to do this episode, Luke, because I had this other episode planned out. I was like, let's talk about some stocks. Let's go bang, 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 give the people what they want. And you thought, let's tweak it a little bit. Let's do something a little bit different. Talk us through this.
Well, yeah, Ben was like, let's do, stocks you've made money out of and 10 baggers. Biggest winners.
Swing for the fences.
Like all the stuff that everyone wants me to talk about all the time and what my next 10 bagger is or whatever. And I think there's enough stuff on the internet, me talking about me. I'm a bit sick of talking about me, to be honest. And I'm a bit sick of talking about stocks that I made money out of. Like, I don't really care. The money I've made, I've spent on stuff. So,
like that suit, for example.
Yeah, exactly. An obscenely overpriced wardrobe.
Quality at reasonable price.
Yeah. So I think stitch up. I said to Ben, why don't we do? And because a lot of young people hit me up, and a lot of young people listen to this podcast, and if they're not young people, they're parents and they've got people, kids and stuff, and they always ask me, how did you hire Ben? Why did you give him the job? What did he do in the interview process? There wasn't an interview process. Can
you find out this mirror?
Those sort of things. And what are you teaching him, and how does how is that development kind of work? Because I think anybody could go back to the first time we put Ben on camera, probably 3 years ago. I'm going to I don't know where. Yeah. And if you watch Ben now present, or like if you're fortunate enough like me to have seen Ben in a meeting, the first company meeting that I took Ben to with me to meet a management team, and now what he does on his own on the road without me even there in those same meetings. So, I personally, and I'm sure other business people can relate, what's interesting to me is, watching somebody come in at 24 years old, and now Ben's 27, and then he'll be 30 and he'll be 35, and watching the development of that sort of story, and I'm sure people who have done it or have seen that happen can appreciate it. It's quite satisfying as a business owner, and certainly he does a really good job. I think he's really good at his job. It's nice. And so that's why I thought maybe we could just do that.
I think that whole lessons learned type of thing is a really good thing. And also, you have quite a bit of a reputation online now as well. Like you go on places like Livewire or other Equity Mates and different media outlets. It's not
shouting to anyone that'll listen. That's pretty much the philosophy there.
Taught how to be a used car salesman by somebody. Don't know who, but it's.
The reality is you've done that at a relatively young age, and you're seen by people young and old as a really credible source of knowledge and investment expertise. Now you write prolifically. You do the research for good research as well. You appear on telly, that sort of stuff. So I'm happy to just talk about this anywhere, and we'll bring up stocks and companies as we go through. And we have the research desk at the end, don't worry about that. So where do you want to start? What do you want to start with?
Yeah, well, I appreciate the kind words to start, gents. But it has been a really interesting journey for me, I suppose, and lots of learnings along the way. I remember in those early pieces of writing that I did, either for you, I think on the Rask website at the time, or Livewire, or even internally, and how Luke would kind of pull apart my writing with slash this out, rearrange this, rejig everything, and then I'd read it and I'm like, damn, that's so much better than what I did, which was just kind of waffle in a straight line sequential order. Anyway, so I feel like definitely my own investing has improved, but what I was kind of keen to do is just go through a bunch of lessons that I've learned from working with Luke, and just through working at Seneca in general.
Yep.
The first one to start with, which I think is probably a good one in any application, is offer things without asking for anything in return. So I feel like there's a lot of mindset out there to just only do things if it helps me. But something I noticed that Luke does a lot is takes the phone call, takes the meeting, takes the coffee, even if it's not quite clear that it's going to benefit me, but you just never know. And it comes to the same as investing. I think one of my biggest edges relative to peers is the willingness to kind of turn over the rocks that, you think you know what's under that rock, but you don't know for sure. Broker meetings is a classic example I use.
How do you mean?
Well, I hate going to broker lunches, for instance, because there'll be a few companies that they have a corporate relationship with, spruiking their wares to a bunch of random investors and corporate advisors. And it's kind of interesting to hear the stories, but there's no real value that you couldn't just pursue on your own. However, you do run into other investors. Before Seneca, I ran into Luke at one of these.
Is that how you guys met?
Yeah, I met Ben at a broker lunch, and there was 20 old blokes, white blokes in a room in suits. And company presented, pretty average company, nothing too exciting. But there was like a baby sitting in the corner. Wasn't even at the boardroom table. He was like sitting on a chair in the corner of the boardroom and pipes up with like these 3 questions for the company. I was like,
Who let him in?
well, yeah, it's school out, and also, they were like actually the 3 most interesting things that anybody had said all day. And so I asked the guy who put the lunch on, I was like, who was the child in the corner? And then I went and met Ben. So,
that's obviously how it started from there.
Yeah. So then I got to know Ben for a while, had a chat to him, and then I said, I want to do this small cap product. Do you want to do it with me? And that's pretty much how it got started.
Yeah.
Cool.
We debated the merits of, actually at the time, it was various lithium companies at extreme length, which is quite enjoyable. But,
But you've been reading the weekly note, and that's how, so
yes,
it was sort of easy.
Which if you're not reading the weekly note.
This is from Seneca.
Yeah.
It's free. Get it on the website. New website too.
Yep. So that was the first one. Second one is learn who to listen to. So I think every management team comes in when they're presenting a story and says the same spivvy, we're so undervalued, blah, blah, blah. And I think a lot of what we do every day is just separating signal from noise. One of the things that really impressed me with the weekly note is it's always data driven. Any charts is centered around data and how Luke's interpreting that data. Whereas you look at a lot of other like broker commentary and it's just trash. Like it's, this stock, even today I think I got a text from someone being like, stock is going up, i.e. that was the reason for buying. It's like, well, is that it? Anything else? Which is just shorthand, but you know what I mean? Like there's a lot of people out there that are salesy and spiffy and don't focus on the data. So I think it really pays. I think one of the stories that you like to tell me about it, one of your best investments of how you assess the management team.
What are you talking about, Francis?
Vulcan Energy Resources.
I mean, this is not, nothing. I mean, we talked about Vulcan and, great. Luke made money, fantastic, all very well and good. But why did we take that 40-cent placement? It was a bit of serendipity. I happened to be sharing an office with Francis in Perth, and I happened to be in Perth working for a period of time because I was going to a heap of weddings or something. I can't remember what it was actually, why I was there for so long that summer. But Francis was telling me about what he was doing, and it sounded really interesting to me. I was interested in EVs and lithium and whatever, but I'd never heard of this direct lithium extraction, DLE stuff before. It all sounded a bit science fiction. But I noticed Francis was heating up his lunch in the kitchen every day and not going out and spending any money. And then I was driving in one day to park under the building, and I've seen like this English bloke, real pale English, Francis, English bloke, on like a bike pedaling down Stirling Highway. And I'm like, get to work. I'm like, Francis, do you ride your bike to work? I was like, mate, you rich, what are you doing riding your bike to work? He's like, oh no, it's good for the environment. I don't want to spend I've got a Tesla on order, but I don't want to like burn the petrol for the environment. And if you know anything about Vulcan, it was all about kind of a move to a sort of a green, sustainable way to produce lithium. Outside of the traditional kind of sources, I suppose, of lithium carbonate and hydroxide. So, and I was like, man, this guy is so deep on sustainability and sustainable energy, and he actually is like living and breathing kind of what he's what he's telling me. And so that was actually kind of the thing that really, I suppose, gave me, I didn't never mention this to him before, and I'm sure he knows this, now, but gave him a lot of credibility in what he was saying, and I probably gave him more credit and more credibility than the rest of the market did for a long time.
Yeah. Yeah, I didn't know that was the story.
Yeah.
And especially when you contrast that to a lot of junior mining CEOs who are kind of trying to parade their wealth around, which is always confusing to me because like, well, you're coming in here meeting with investors, clearly need to raise money. So why do you need to raise money if you've got so much money of your own? Well, clearly the project's not that good.
Put your own money into it, mate.
Yeah, that's it. Okay, so that's number 2 is learn who to listen to.
Number 2. So number 3 I had, don't blindly accept the prevailing narrative. So I think there's a lot of noise out there, especially when you're working in the industry, from your peers, from your competitors. We often talk about fundy favourites and how small cap managers crowd into the same set of stocks for various reasons. But if you're only kind of reading into the media or the research or whatever is put in front of your face, then you're going to think exactly how they do. So like I'll often we'll be talking about ideas and I'll present an idea to Luke and he says, oh yeah, interesting. Like, where'd you get this idea from? And I've quickly learnt that the most powerful ideas are your own original ideas. So if I can explain, I sort of stumbled upon this, which led me down this path, which then knowing the people involved has become a good idea, then whereas if I say, I read off, I don't know, Twitter or Fund Manager XYZ's monthly report that they're in it for these reasons, well, I'm kind of last to know. So
like, I don't really want to buy something that
because other people
Rafi at L1's already bought.
Yeah.
You know, like it's not that's not going to help me get better returns than him. Now, I'm not saying that we don't get ideas from other people. We do, but it's the 1% of our ideas, and I try and we both try and spend our time generating kind of original ideas that even if they're not original, nothing's original, but we try not to sort of we try and steal information and we try and steal context from people, but then we try and sort of grow that in-house into an investment idea.
I think you said that in episode 2, Ben, where you said like you just go there, you just sit there and read literally all these announcements as they come through the ASX. I literally just read them because that's the source material. Right?
People don't read. Like, I mean, the amount you can learn by reading. Don't tell people what this stock is because I don't actually.
I already know it. I think
I don't actually want to do it.
And I'm excited about it.
We were reading. Like, we had a question today. There was a question that needed to be answered about a company that we think could pay a dividend and a special dividend way above what the market's currently expecting, and I said to Ben, what's in the management incentives when's the management getting their shares? Because they won't do it until they won't announce, like, don't declare the dividend until they've got their shares. And so we're just reading the announcement, and Ben's like, this CEO is on blah blah blah, and I was like, I told you. I was like, that's not going to happen until after June 30.
Yeah,
and so it's just had the ability, I suppose, to know that pattern and know that you've seen that a few times before, but then read and get an understanding of what is the management team actually incentivized to do here? Are they going to declare a special dividend at the, this result or later in the year or when? We'll
they're not going to do it until they've got the shares.
When they're going to do it when they're going to make the most money out of it.
Yeah,
So
it'd be crazy not to. Yeah, fair enough. I like it. Okay, so don't blindly accept the prevailing narrative.
Yeah,
cool. That's number 3.
Yeah, in at 4, I had "you're wrong until you're right," which sounds kind of obvious, but we bandy that phrase around a fair bit because
I think I've heard Luke say it before.
I say it a lot.
It's a Laretive special, that one. But it's so true because anytime you're buying a share in a company, you're buying it because you think the market is missing something or it's inefficiently priced, and when I buy it, at some point it's going to go up and people are going to price it more efficiently, and then I'm going to sell it. So by definition, any time you buy a share, everyone is effectively telling you every tick, every second of the day that you're wrong until such a point where a catalyst plays out or the market changes direction or whatever it might be, and you become right. So I think it's easy to get bared out with some stocks that kind of look like they're moving against you in the short term, but there's countless examples. Like I remember in the large cap funds or the large cap SMA, it was Allchem or Arcadium Lithium. That was we had a positive view on the company, the assets, and the commodity price. And yeah, when lithium was on the nose, that was kind of getting torched. So we didn't really think people appropriately understood the nature of brine assets versus hard rock, which is kind of the WA Australian staple. And then until one day when Rio turned around and bought them out at a huge premium, and suddenly we were right for 2 minutes. But the rest of the holding period, I can't remember how long it was exactly, but...
I was after doing that Wildcat site visit. We were on the bus. Everyone, we're having a few beers on the bus, which is sort of standard at the end of a day on these site visits, and everyone just starts talking shit, like stocks, right? And so pitches a stock, what do you like? And you've got to pitch something. I mean, this is a bus full of analysts and fund managers, so I can't be like, I like BHP. Like, you've got to pitch something that they're all going to disagree with, so you can have a...
That's your currency.
Have a whack. And so, I remember pitching Allchem and getting laughed at. And then I just sent the most smart-ass email back, just copied them all in. It was just like, Rio bid price. Just like...
So that's so true, though. Actually, now you think, like, you always feel like you're wrong. Even if you are in the green, you still feel like you're wrong. Because you feel like, is it going to keep going up?
If you don't feel like you're wrong, sell.
True.
That's the reality is that I think...
that's the difference between beginner investors and people who know what they're doing.
A little bit. And I did some work recently, nothing to do with this topic, but it was in the weekly note last week or the week before. I can't remember. It all blurs into one. But, the correlation between the average stock on the ASX is about 18%, 20%, correlation covariance matrix. So, there's always going to be a degree of just market beta that you can make money out of, but it's never going to be enough to outperform anything. So, we need to understand, I suppose, that, buying stocks is adversarial, it is competitive, and it's competitive with everybody else who's telling you that you're wrong. So, certainly maybe it's not even in the number of people, but it'd be in the weight of money. Yep. I think it's you have to remember it's a game of being wrong, like Ben says, 99% of the time.
Yep. Cool.
Yep. We could provide countless stock examples, but like
what's your favourite one right now that we own that you think everyone says we're wrong about that we think we're right about?
HMC Capital has to be.
Is that data centers?
It's the fund manager that owns
David DePilla's fund manager.
Funds, including REITs, which is like the HomeCo, Daily Needs REIT, the HealthCo, Hospital REIT, and the DigiCo, which is the data center REIT.
Yep.
And so they had a confluence of issues, and all of a sudden, all the media was slandering David DePilla like he was
the worst,
a nasty, word. So,
interesting.
Yeah, that was the prevailing narrative. It reminds me a lot, even though it's a completely different stock, completely different sector, to MinRes. Mineral Resources, which had a bunch of issues. It had debt. It had Chris Ellison was being dragged through the papers for alleged tax evasion.
Insider trading stuff on that other thing.
Commodity prices were going against them. And then this big iron ore project, Onslow, had some issues with the haul road that they built, because the whole premise was that they were building this long haul road all the way to port. Had some surfacing issues. And so everyone was really bared out. Stock went from like $70 to
Teens.
15, I think. And then at peak bearishness, all this was happening. Stock's back today at $60, $70. No, you don't hear peep out of anyone anymore. So
everyone who's a genius now, pretty quiet now.
So we think HMC is the same thing. It's come down from, I can't remember the peak.
It was 9
or 10. I reckon you'll be able to pull it up there on. But
even north of that.
North of 10, and it's now 3. It did get to $2.50, which is below the value of its co-investments and net tangible assets, including like holdings in these underlying REITs, which are all very cheap on their own.
I remember you made
basis,
the
case, which is why we bought it, right? That was the original kind of thesis.
So you're getting the fund manager for free. It's the same kind of thing. Like you pay for less and less, and all of a sudden you're getting extra pieces of the business for free, as long as you can stomach that volatility and so like, even though I think we probably have talked about it at various points when it's been $2.50, but also when it's been $4. And it's easy for people to kind of sit on the sidelines and criticize, saying, I bought it at $4, but the reality is that we've bought this because we have a view and we think that it's going to be $6, $7, $8 on a medium term view. So that's what we're going to do. So
HMC Capital, HMC is ticker symbol. So that's number 4.
Yeah, and just to finish off on that, I think, especially given that I have been fortunate enough to be put in these positions and talking on podcasts and TV and writing articles, you do get exposed. My ideas are always out there in the public sphere. So Luke and I are often getting criticised for various things, and a couple of things that he's told me, which I think are bangers for life in general and have helped me a lot. One is the the value of infinite games versus finite games. So a finite,
What's that book on? This is not my idea. This is from I pinched this from a book. It's like I think it's Simon Sinek, but don't quote me. I've read it somewhere.
Yeah.
Sorry,
I'll bring
Ben.
it up.
Yeah. So finite games are played for the purposes of winning, i.e. if you would pick one stock and it goes up or down, you've either win or lost. That's not our business. We don't, put our heads on, nail our heads to the mast on any one given stock. Like we're playing an infinite game, which the purpose of which is to continue playing. So it's just stacking. I hope that I could be doing this for, decades, not just years.
I don't want to be doing this for decades.
Luke will be long since retired if I'm still going by decades.
That's why he's grooming you.
So that was one thing. And the
training, it's called training. It's not called grooming.
You did say.
No, we're not doing that.
Yeah. And then Man in the Arena is another one. So
is that a Chamath
That's
thing?
a Theodore Roosevelt
back in the
speech in the
day,
1900s.
Yeah, but LeBron James
Just a
stuck
good
it on a
quote.
locker. That's where I got it from.
Yeah.
I'm not that well read.
Yeah.
You can read it, but I mean, the summary is like people that are doing more than you or have been in the arena themselves don't criticise you. So in any industry, just remember that.
Yeah, it's so important.
Because otherwise, if we listen to every bit of harsh feedback or criticism or someone telling us that we can't do our jobs, would have quit.
And the reality is
after
like
starting, so.
if you're following our stock tips and not doing well, it's your problem. Like your process is stuffed. Our process is fine. We've done 20% per annum since inception returns. Like if you want to know how good we are at our job, it's on the website. Yeah. So the issue is not our ability to pick stocks. It's just that the realities are the ones that you've chosen to follow.
Yeah.
So I think that. Like I said to you, I'm not in this industry to make friends, and certainly I've been fortunate enough to make some great friends out of this industry. But the last thing we're worried about is people who don't and can't do the job.
Well, yeah, I like this line, you're wrong until you're right. And it kind of ties back in with the other point that you made.
Sometimes we're wrong, we realise it and we get out of it. Like it doesn't mean
sometimes you're wrong until you're wrong.
But you're wrong. Yeah, you're wrong. You are just wrong. Like there's also those scenarios.
You wouldn't be able to get into this game unless you were willing to have that thick skin to talk about these types of ideas publicly.
Especially the way that we do it. We're building a business. What I call like hand-to-hand combat style. We're out there signing individual clients. We're growing our fund $100,000 at a time. Yeah. So. We're not fortunate enough to have some rich uncle or some wealthy backer who, just seeds all our product for us. Like we are a small business trying to grow every day.
Cool.
That's no different to you, mate, to be honest. That's why we're mates, is that, it's the same sort of, we face the same challenges.
For sure. Number 5, understand the plumbing.
I reckon this is something that when I was first talking with Luke and John, JB, I said, what do you think you guys, like the strengths, what do you guys do well? JB said to me, we understand the plumbing, which is something that, Luke,
what does it even mean?
I don't know, but it sounds good. No, but it means like, in terms of like the financial services sector that we operate in, is that you can only create the right products and services if you really understand what's going on in the industry and how the competitive dynamics are. For instance, I've worked at a couple of other financial services places, different sizes, and you kind of see the challenges that they face. Like if you're a larger advice group, you're basically just bogged down in administration and paperwork, and you end up it kind of, how the business is set up skews the incentives, not necessarily, I believe, in the favour of the clients, just by the nature of the regulation and the processes within the business. So everything is set up basically within Seneca to streamline as much as possible and align as much as possible. Yeah. And that's it. So
very lightweight, very like pure investing, right?
Yep. Yeah. I mean, you know how our business works. Someone like, this is nothing sort of unknown to you. But, I mean, what I mean when I say to people we understand the plumbing of things, and I try and understand the plumbing of everything that's important to our business, and that is that, starting, if I want to buy a share, how does that actually work? Where does the share come from? How is a share created? Where does the money come from? How does it settle on time? How do we ensure that one person delivers and the other one doesn't pay? How do we, when it does come back, it goes into a custodial arrangement. What is a custodial arrangement? How are they licensed? How does a custodial make money? Like, I think that you could ask any advisor, any stockbroker on the street, and I don't think 90% of them could do that. I can do that with you from the company issuing the shares all the way down to Australian super owning it, and how, like, we know how all that stuff works, how all the money flows and ties together, and how who takes a clip there. And I could probably do a James Wrigley and go and do a whiteboard session on it, but like, I don't. There's no incentive.
Classes.
Yeah, I probably be a nicer bloke as well would help. But the James is far too nice to be compared to me. Anyway, you get my gist, right? Is that I think you need to understand the nature of doing it. We talked in the last episode about how much you understand, the business of online sort of media in this sector, and some of the things you've taught me over the journey. So yeah, I just think about it. It's about being a good professional, and I just don't think there's actually that many of them out there.
Yeah.
I was going to say on the same note, just quickly, that I remember when we first did podcasts and articles with you, that I would write, just tap out a piece of garbage, and then you would kind of come back to me and be like, if you can rearrange the phrasing and stuff such that it works better on SEO or whatever the platform was. Same thing, but then different plumbing.
That's the plumbing of what you do. It's a different thing.
Yeah, for sure. Number 6, Ben.
Yep. Focus on what really matters. I think we talked a little bit about in the first episode in this series how we don't really value DCFs in and of themselves, because if you're the smartest analyst in the room and you've modelled something to within an inch of its life, that's not that valuable. I mean, something like Pro Medicus goes from 300 to 120, and I'm still scratching my head looking at my $310 model thinking, what went wrong? So I think you've got to... It's an important distinction between directionally correct and absolutely correct. And I think I've always, come through, you go through university and you go through stuff thinking I want to be as correct as possible, but sometimes you've just got to focus on what actually is mattering, and if that's a share price, it's the 1 or 2 or 3 most important things that are going to move that share price. So XRF Scientific and Idea we've talked about a fair bit before. What's the key metric there? Is it the fact that it's cyclical or expensive?
Which everyone says it's cyclical.
Which everyone says all those things, but is the key metric that profit and sample volumes, which is a key input to their most profitable division, is kind of going up and to the right still and on trend? I would argue it is. REITs, if you own a REIT, well, it can be the cheapest real estate trust in the world, but if interest rates are going against you, you're probably going to get torched still. So all those kind of things.
It's another like Lukeism that I'm constantly bashing at anyone who'll listen, but what is the most important thing about this stock? Like, what's the most important thing for this stock? And I think if you can't identify the most important thing for your stock beyond the share price going up, is I think you're in a world of hurt. Like you need to tool up and get wise on that thing quick.
And that's kind of like with good research. We
talked about the catalyst,
but also like at the very top, we have an investment thesis summary or whatever it's called.
That is the most important thing for the stock.
So if you're not reading the rest of the report, you understand the idea. Whereas we read a lot of ideas from anyone, and it's just kind of a full spiel, and it's like I'm left at the end thinking, okay, but what's the one key message here? Like, why am I buying this stock?
And I've not made it to the end because my attention span's not that long.
Yeah.
Yeah, for sure. This podcast is proudly brought to you by Pearler, the official brokerage platform of Rask. With Pearler, you can effortlessly automate your money, whether you're investing in ETFs or shares from Australia or the US stock market, whether you're a grandparent or setting up a kid's account or your own account. You can do all of that with full automation on pearler.com. If you want to learn more, head to pearler.com/Rask. And of course, before you invest in anything, be sure to read the legal documents like the PDS and FSG. Thanks for watching this Rask podcast. Okay, so that's number 6 of I believe, is it 8, 9? You got a teaser on the end there.
Yeah, I had
for us.
8 with a teaser.
Okay.
Oh, here we go.
Okay, so number
looks nervous about.
bit more me
so,
time.
so number 6 was focused on what really matters. What's number 7?
7, when you've got a good idea, you need more than one way to make money out of it.
Give us an
So,
example of that.
an example, for instance, like MinRes. Everyone was looking at the Hall Road, blah, blah, blah. Red Hill, again, we've talked about on Rask before, but that owns a royalty over that project.
Yep.
The issues with MinRes were primarily debt and leverage. Those same issues aren't faced by the royalty holder who just gets a share of the revenue, not the profit or the balance sheet.
Mm-hmm.
So that was one. Rocks and VMC and Franco, like there's multiple ways to skin that cat. We think VMC, as we talked about in the previous episode, is the best expression of that that work that we've done understanding the quality of the You and Me Gold Project in Western Australia. Mm-hmm. And then even just before we talked about like HMC, that's a really interesting one because they've got issues with their underlying REITs. Not the daily needs one, but the Health Co, which is the hospitals tied to HealthScope, which is
In administration.
Yeah,
in administration. And then Digico, which was a float that I think it floated at $5, was it?
Yeah, it's a premium to book value, and now it's trading.
It's trading at a huge discount, $2.40-ish.
Yeah, well.
And so is the best expression HMC, HDN, HCW, Digico, or other? Now, in general, we think it's HMC, but it's quite a nuanced view because if we thought Digico could be a catalyst if they prioritised their assets, i.e. sold the US to reinvest in the high returning Australian data centre.
Which is what they're doing.
We actually bought Digico just because of that thesis, plus how cheap it was and how underappreciated we thought the assets were. And so, yeah, a little announcement has spiked that up. Still trades at a big discount, but we own a bit of that. And, yeah, without going into too much detail, we actually quite like one of their other investment vehicles. So multiple ways to skin the cat.
I think that's so good though, because like you're hunting for things that have payoffs, right? And there's so much work that goes into finding one good idea. But then if you can find other ways to leverage that and to have that kind of return to you, that's amazing. Why wouldn't you do that? Most people don't think like that though.
And Ben's playing out, like we're playing point in time, right? Like the kind of 4D version of this is that it's forever. So all the work we're doing now on I'm just going to MinRes and Red Hill and royalties is helped us with VMC and is going to help us with
X amount of other things.
How many other things down the road. Yeah. It's like Ben said, it's all about that infinite game kind of mentality and the sort of stacking. You're stacking your expertise, stacking your experience, stacking your skills such that when these opportunities do come up and next time I talk to you in a year, instead of having 4 ways to make money out of an idea, I've got 7. And you're constantly improving as well. So I think,
that's good.
Yeah, it's important because if you want to make money, you're not going to have enough good ideas. You need to squeeze all the juice out of them.
Unless you subscribe to good research.
You can have 25 out of good research at least.
Was that book that you were talking about before, Finite and Infinite Games by James Cass?
Maybe, yeah.
Yeah, okay.
The problem with me is I listen to audiobooks, so I never see a cover. And like I said,
so they become original ideas.
So it just goes in my brain, and I actually listen to them the hour before I go to sleep at night, which I know is terrible. And the optimization gurus will tell me I shouldn't do that, but helps me go to sleep. So distracts me from my life. But yeah, so I do get I sort of absorb it. But I never see the cover. I never sort of notice the author or anything like that because I just skip forward to the first chapter.
Yeah, for sure. Well, I'll put a link in the show notes because I think it is this one.
Yeah, there's probably only one.
Yeah. So number 8, Benjamin. I like this one.
It's one of my favourite ones. It's that you're not going to beat Andrew Mitchell at being Andrew Mitchell.
So for folks that don't know who that is, who's Andrew Mitchell?
He co-runs and founded Ophir Asset Management.
Which is a big deal.
Big deal. I mean, they've got I think a small closed fund that's got outstanding numbers, and they've also got a larger listed fund, OPH, as well. But I'm not trying to plug them, but they've been really successful at what they've done. They manage well in excess of $1 billion, I believe.
I think so, $1 billion plus, yeah.
And yeah, they've just done a really good job. But
and anyone could apply this to any industry.
Any industry. I mean, there's a bunch of fund managers or other industries that you can pull successful people up. But the problem is we can't just replicate what they've done or what he's done or what any of these other people have done and have the same success because,
Well, Andrew's a 6'5" private school white boy. Like I'm not one of those. I don't know if you've noticed. So you know, you're not going to have. That's not my life. Like we've lived different lives. We have different experiences.
But and the part two is you might just beat him at being Ben or Luke or Owen.
Yeah.
So I think embracing our differences and embracing our unique style, which I do believe is unique in the market, means we'll find different ideas. We'll find different, good research we think is pretty unique as well. So
yeah, definitely.
I think it's been a big revelation for me is like, I think when you first come up advising and you've got other more senior advisors telling you, well, you need to do this and you need to do this and you need to do this to get clients. And then you try those things and you kind of realise that it doesn't work for you. So, yeah, the only way I've ever had any success in this industry, whether it's from an investment perspective or from a grow my business perspective, which obviously related, but is always just to think about my own experiences, my own life, how I look at the world, my views on things, my preferred way to communicate, how I talk to my mates, how I talk to my family, and just be myself. And I think I try and encourage Ben just to be himself, and to not worry about if boomers don't like me or XYZ cohort doesn't like me. And same with investing. Like if we think we've got an idea because we're the only people who can see a certain angle on something, we're going to back ourselves in. Now we might be wrong, we might be right, but we're not going to die wondering. And I think so far, more often than not, it's working out for us.
I think that shows up too. I think it shows up because the two of you are kind of seen as like this duo, right? But you're still unique in the way you approach things and that sort of a thing.
We argue lots. We always disagree on stuff. Like that's half the point.
Yeah, definitely. There are 8 things here. I'm going to quickly go through them. Then you need to give us your bonus.
Yep.
Number 1 is offer things without asking for anything in return. I couldn't agree more for that. It's worked for me for what it's worth as well.
Yep.
Learn who to listen to. Don't blindly accept the prevailing narrative. Really important. You're wrong until you're right. I think you've said that 100 times, but maybe I had to hear it from Ben to be like,
actually pay attention. That sounds about right. Yeah, sounds
that's
about
pretty
right.
good. You should tell Luke about that. Number 5 is understand the plumbing. So important. Like in our industry in finance, the amount of people that don't actually understand things, like essential things, you're like, don't you, like, even just like the compliance rules that we have to operate by, they don't understand. They've kind of just taken what someone else has said and just run with it. And you're like, but no. Anyway, number 6 is focus on what really matters. Number 7 is when you've got a good idea, you need more than one way to make money out of it. Love that. Number 8 is you're not going to beat Andrew Mitchell being Andrew Mitchell, but you could insert anyone's name there. But that's so good. So you've promised us a bonus lesson learned here, Benjamin. Don't forget, we also have the research desk, which is coming up just after this. This is where you get to pick. You get to try and guess the company that they're talking about, and if you get it, Luke will give you a bottle of wine from WA's finest establishments, he tells me. So you can use the YouTube comments or Spotify for that.
Made that wine yourself, or is it just store-bought? Okay.
just store-bought.
Just clean skin poured into a new bottle. Yeah.
Okay, so what's the bonus lesson before we get to the research desk?
Look, this is just a bit of fun. I thought if I've learnt nothing else from working at Seneca and working with Luke, it's that I'm a lot better at quoting movies. So chop a read, no cashier, Robbo.
Yeah, I'm bad on movie quotes, as everybody knows probably.
But you do bring the pop culture into the conversation pretty regularly.
Yeah, I mean, I just find that, I don't know, but I say like life imitates art, and I do find that in a lot of things, there's a lot of investing parallels, and
Moneyball, Big Short analogy. We always
Moneyball, Big Short.
Find ways to tie it.
There's a few.
There's a few. That's good. Now, if you do want to join good research and you actually want the names of the companies that the guys are talking about and what they're researching, you can head to goodresearch.com.au. The discount or the sale, it applies until June 30th.
June 30, midnight.
Midnight, June 30th. So you can use the coupon code RASK, that's RASK, gets you 10% off a 1-year subscription, so $500 off, or gets you 30% off a 2-year sub, which is substantial savings. It brings it down to 7,700 for 2 years.
Yeah, so 3 discount.
Nuts and bolts, it's roughly 25 stock research reports a year.
Yeah, we do.
Roughly.
Technically, it's 23, and then we do 2 wraps. So every 6 months, we do like a wrap episode
Recap.
where we can essentially go back over the last 6 months and look at kind of what's worked, what hasn't.
If we still like
it, bit of an update.
Yeah, cool. That's great. Actually, really useful. So that's goodresearch.com.au. There's plenty of information there too to learn more about the guys. And we do these segments at the end called the Research Desk, which is this idea that you guys can kind of give us a few teasers of a company that you are indeed researching, which may later come out as a research report on Good Research. And if the community can guess it on YouTube, comments, Spotify, wherever you like to just rave and rant about things, send it in and we'll just keep a watch. And if you get it right, we'll give you a bottle of wine. Who's going to go on this one? Who's going to give us the teasers?
Oh, Ben can do it. I'm sick of talking.
All right. So, I suppose we've spoken a bit about HMC Capital on this episode. So, in that style of idea, there's another company, and I'm going to give you a big hint by saying it's a financial services company.
You guys should get this one.
In the spirit of understanding the plumbing, I think this is the easiest to get. So again, I'll rattle off a few points here for you. It operates in a similar industry to our own, as in Seneca, what we do. So we should understand it. It has sold off on issues that we don't think the market is understanding
well.
Mm-hmm. Trades on a record low valuation. I'll even go so far as to say single digit PE.
It is single digit PE.
High insider ownership, pays a dividend yield, and we expect to double our money on a long-term view.
So you got a lot of conviction in it. So financial services, single-digit PE, similar industry to Seneca.
Yep.
Okay.
Have a ponder.
High insider ownership.
Just like Seneca.
Yep. Pays a dividend.
Does Seneca pay a dividend?
Seneca's it will just be paying its a dividend in July.
Wow, times must be good.
Yeah.
That's something's got to fund those bottles of wine.
Okay, so that's a good one. So you did have each of the research desks had a different stock in them, and the first two were kind of like a trip down memory lane to kind of like lay the pavement for the ideas and the guessing. Last episode, it was a bit more direct. So if you haven't listened to the previous episode with the guys here on the series, go and check that out. That was a bit more direct. You even said it's like this company. That's what this one is. But this one today is financial services, which I think would be the first one or the first time you've said that. It's really, really interesting. I feel like I might know this, but I don't feel like I know it. That's the thing.
I think if you think you know, guess, and you want that bottle of wine, because I think if you the keen Seneca watchers, Weekly Note crew will get this one quick.
Because there's kind of two that I'm thinking of that this could apply to.
So it's going to be, you've got a 50-50, I reckon, if you're paying a lot of attention.
Best dressed, there's 2 bottles of wine up for grabs. Whoever gets it in first.
And Owen's picking it'll be a rant. Don't come at me. Talk to Owen, get his email Owen about your wine and I'll organise it. Yeah, too easy. But final reminder that the Good Research subscription, the sale ends this coming June 30th at midnight. So you can head to goodresearch.com.au. This whole Small Cap Playbook was brought to you by Good Research and by extension the team at Seneca Financial Solutions. So you can find them online. You can find more of Ben's work if you think he had some decent things to say in these 8 points, maybe even number 9 with the movie references. You can find them both online. They're both very active all over the interwebs. So I'll put some links in there in the show notes for you. Ben, thanks for sharing all these lessons with us, mate. Really appreciate it.
Thanks a lot for having us.
And Lukey, always a pleasure, mate.
Mate, appreciate this series. Been really good. And yeah, enjoy coming in with you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.